Everyone is obsessed with interest rates right now. And honestly, it's costing people a fortune. But what if I told you that obsessing over interest rate is costing you more than any rate ever could? I'm Tristan. I've been a loan officer for 7 years, and I've sat across from hundreds of buyers, first-timers, investors, people starting over, people moving up, and most of them come to me with the same question: what's the rate? And I understand why. That's what gets advertised. That's what lenders compete on. That's what you see in every ad, every piece of mail, every online comparison tool. The entire mortgage industry has trained you to believe that rate is the most important factor in a transaction. But here's what they're not telling you. Rate is one variable. One variable in a financial decision that has at least 25 plus variables, and most of them matter significantly more than whether you're at 6.25% or 6.5%. I'm not here to tell you that rate doesn't matter. It does to an extent, but I'm going to show you with real math how much it matters relative to everything else. And by the end of this video, I think you're going to see your home purchase in a completely different way. We're going to cover 25 factors today. Some of them are going to surprise you. Some of them are going to change the way you think about real estate entirely. And at least a few of them are going to make you realize that waiting for a lower rate might be one of the most expensive decisions that you ever make. Before we get started, just keep in mind that the math examples in this video are reasonable approximations for illustration purposes. I may do a bit of rounding as I'm speaking on camera, so the concepts and conclusions are what to focus on here. Also note that the examples used in this video reflect a 30-year fixed rate mortgage, principal and interest only, with standard amortization unless otherwise specified. Factor number one when purchasing a property that matters far more than interest rate is purchase price. You can refinance your rate, but you can't change your purchase price. The single most common mistake that buyers make is overpaying for a home, regardless of rate. The math makes this brutally clear. Let's look at two different home options. We've got home option number one, and it costs $720,000 at a 5% interest rate. We've got home option number two, and it costs $430,000 at a 6.5% interest rate. The monthly payment on option number one is $3,671. The monthly payment on option number two is $2,582. The monthly difference between those two home prices is $1,089. That's a big difference. But let's take it a step further. Let's see what would happen if we invested those monthly savings. So $1,089 per month in 1 year is $13,078. If that were invested for 10 years at 10% a year, the gain on that investment would be $223,000. So this illustrates that a high rate on the right loan can build hundreds of thousands more wealth. So the biggest mistake is overpaying for a house even if the rate is good. The price is permanent, the rate is not. Factor number two is appreciation potential and the cost of waiting. Many buyers will wait for rates to drop before they buy. But while they wait, home prices keep climbing. And the gain from a lower rate ends up being tiny compared to the appreciation they miss while sitting on the sidelines. Let's take a look at an example. A buyer is looking at a home that costs $400,000. Let's say in their market, appreciation is 6% per year. Here's what waiting 5 years would actually cost them. So if the home was purchased today at $400,000, over the next 5 years, with an appreciation rate of 6%, that home would have gained $135,000 in equity. So now let's say that you go to buy that same home 5 years later. You're now paying $535,000 for that home. And you're starting $135,000 behind. So let's compare a buyer who buys now and a buyer who waits 5 years. The buyer who buys now, putting 5% down, would have a $380,000 loan. They'd have a rate of 6.5%, and their monthly payment would be $2,400. The buyer who waited is going to have a $508,000 loan. They'll have a point lower interest rate at 5.5%, and their monthly payment is going to be $2,887 a month. The monthly difference between those two loans is going to be $485 more for the buyer who waited, in spite of the lower interest rate. Now let's compare what that lower interest rate is actually saving you compared with the equity that you would have gained by buying sooner. So if we just isolate the interest rate, We compare 6.5 and 5.5. Let's take a look. So the same loan amount at 6.5% would be $3,214 a month. At 5.5%, it's $2,887 a month. So the difference is $326 a month. Over 5 years, that totals $19,600 a month. Now let's subtract the $19,613 a month from the $135,000 in equity gained by buying earlier. So your net loss from waiting is around $115,000. Now, what if that $135,000 in equity was pulled out with a refinance and invested? Let's look at it over 10 years at 10% return on investment. That investment would have yielded around $350,000. Waiting doesn't just cost you appreciation, it costs you the compounding on that appreciation. So every month or year that you wait for a lower rate, houses continue to get more expensive. A strong market will beat a lower rate every single time. Factor number 3 is market strength. Where you buy is going to be more important than what rate you get. Factor number 2 showed an example between two different rates in the same market. In this case, we're talking about two different markets at the same rate. A higher rate loan in a strong market will dramatically outperform a lower rate loan in a weak market. Location quality will be a bigger variable than interest rate. Let's take a look at an example. We're going to compare two buyers, same loan size, different markets. Buyer A is buying into a weak market. They've got a purchase price of $400,000 and an interest rate of 6.5%. The market is appreciating at 2% per year. The value after 10 years is $487,000, so their home appreciated in 10 years $87,500. Buyer B is buying into a strong market. They also have a purchase price of $400,000, also have an interest rate of 6.5%. But their market is appreciating at 6% per year. Their value after 10 years is going to be $716,000. So their home appreciated $316,000. The difference in wealth created by these two borrowers in 10 years was $228,700. Now, for the sake of comparing this to lower interest rates, let's imagine that they got a point lower interest rate. So instead of 6.5, it was 5.5. And let's take a look at what would have been saved in comparison with equity gained in a strong market. So the monthly savings on a point lower interest rate would be $260 difference. And over 10 years, that would total $31,000. So when you compare that to the $316,000 in equity gained, market strength beats interest rate about 7-1. So what drives a strong market? Well, you're going to want to look for things like population growth, job creation, infrastructure investments, and migration trends from other areas. Investors and savvy buyers buy into markets, not just homes. So to summarize this one, a house in a strong market at a higher rate will always beat a house in a weak market, even with a lower rate. It's not even close. Factor number 4 is scarcity of the asset. Not all properties appreciate equally. Unique and irreplaceable assets will appreciate faster because there is a scarce amount of supply. You can build more houses, but you can't build more waterfront, more mountain views, or more acreage in a desirable area. Scarcity factors that drive premium appreciation are things like waterfront, canyon, mountain, or view lots, historic districts with strict build limitations, or infill lots in already fully built out cities. When demand grows but supply cannot, the prices of those properties will grow faster than the general market, often outpacing interest rate savings by tens of thousands of dollars. A scarce asset in the right location can easily appreciate $50,000 to $200,000 more over a decade than a non-scarce property. There's only so much waterfront, there's only so much acreage. Scarcity is a force that no interest rate can compete with. Factor number 5, land value and lot potential. While the structure on a property depreciates, the land appreciates. Buyers who understand lot potential, the ability to subdivide, rezone, or add units, can create equity that has nothing to do with their interest rate. Let's look at some quick math on this. Let's say that you bought a property for $400,000. Let's say that later you subdivide the property into 3 different lots and you sell each lot for $200,000 apiece. Well, you've just made $600,000, meaning that you made $200,000 on your original $400,000 purchase. That's $200,000 that you made that interest rate had zero impact on. So you're not just buying a home, you're buying the dirt underneath it, and that dirt can be worth a lot more than any interest rate that you get. Factor number 6 is equity creation through improvements, sometimes called forced equity. Appreciation is passive. Equity creation with improvements is active, meaning you can do it right away. Buyers who purchase property with upside, like cosmetic changes, layout changes, or functional improvements, can immediately create equity that will dwarf interest rate savings. Here's an example. Let's say that you bought a property for $300,000. You put $40,000 into renovating the property and doing some cosmetic updates. The new value after renovation is $420,000. That's $80,000 in equity instantly created. Now let's compare this to interest rate savings. Let's say that you had a $285,000 loan, which would be 5% down on the $300,000 purchase price, and you saved 0.5% on interest. That would be $92 a month saved, and over 5 years, that would be $5,560. The equity through improvements, or forced equity, gave you $80,000, and the interest rate savings gave you $5,600. Now let's look at a simple kitchen renovation example. Let's say that the cost to remodel the kitchen was $25,000. It added $60,000 to the value of the property, so the net gain was $35,000. Let's say the cost to remodel the kitchen was $25,000. That adds $60,000 value to the property, so your net gain in equity is $45,000. That return on your $25,000 investment, 140%. The right fixer-upper at a higher rate will outperform a turnkey property at a lower rate. You're buying the upside, not the finishes. Factor number 7 is paydown strategy. Your paydown strategy will provide you with multiple ways to beat a lower rate. Let's take a look. A borrower at a higher rate who actively manages their paydown strategy can end up dramatically ahead of a borrower who simply accepted a lower rate and made minimum payments. Rate is just one lever. Paydown strategy is another, and it's entirely in your control. Here are the base numbers that we're going to use for a comparison. We've got loan A, $400,000 loan, 6.5% interest rate, monthly payment of $2,528, and we've got loan B, $400,000 loan, 5.5% interest rate, monthly payment of $2,271. The difference in those two monthly payments is $257. Now, what paydown strategies are available that could get you ahead? Extra payments. This is probably one of the biggest and easiest ones. Let's say in this case, a $300 extra monthly payment is going to be made. Then you've got the biweekly payment strategy. This is 26 payments in a year with one extra payment made per year, a 13th payment. They could also do lump sum contributions from tax refunds, bonuses, or commissions applied directly to the principal of their loan. There's also the concept of velocity banking, which I'll do another video about that's more in depth. The concept is that your loan is a HELOC and you use it as a checking account. And by depositing money into that checking account, you are consistently reducing the principal and you are paying less interest. Now, this is a little bit more of a complex topic, but it's really simple when it's fully explained. So I will do another video on it, but just know that it is another paydown strategy. You could also use a home select or an all-in-one loan. This also functions like a checking account, and it applies all your income to principal daily, thus dramatically reducing interest accrual, constantly reducing your principal balance. So let's look at some math between our higher rate borrower and our lower rate borrower using the extra payment method with the $300 a month extra payment. So our borrower has the 6.5% rate. It's a 30-year loan. They're going to put $300 extra towards it a month, which is going to shave off several years from the loan. So their loan is paid off in 22.4 years. The interest that they save by doing that is $149,500. And they cut 7.5 years off the loan. Now let's say the lower rate borrower just makes their minimum monthly payment. They pay their loan off in 30 years and they pay $417,600 in interest. Our higher rate borrower, using the extra payment strategy, pays off their loan in 22.4 years, and the interest they pay is $360,500. So the active paydown strategy closes the gap and comes out ahead by $57,019. So it's not just about the rate that you get. It's about how you manage your loan after closing. Strategy is always going to beat rate. Factor number 8 is loan balance. On a large loan, rate will matter more, and on a small loan, rate will matter less. The same rate difference will produce a dramatically different dollar impact depending on the size of the loan. On a small balance, rate obsession is almost mathematically irrelevant. On a very large loan, it becomes more relevant, but other factors will still greatly outweigh it. Let's look at the monthly payment difference on a 0.5% difference in interest across different loan sizes. So on a loan of $150,000, the difference in monthly payment would be $48. On a loan of $300,000, the difference would be $97 a month. On a loan of $500,000, the difference would be $162 a month. And on a loan of $700,000, the difference would be $227 a month. So you really need to know your loan size before you obsess over rate, because a 0.5% on any loan is really not a financial strategy. Factor number 9 is cash flow potential. If a property generates rental income, the cash flow can partially or fully offset any interest rate concern. And a property that cash flows positively makes the interest rate almost irrelevant because someone else is paying down the debt on your asset. Let's look at an owner-occupied example with rental income. So let's say they're renting out an ADU, a guest house, or a room. The total mortgage, PITI, principal, interest, taxes, and insurance, is $2,500 at 6% interest rate. The rental income from the ADU or the spare room is $1,200 a month, and your net housing cost is $1,300 a month. Now, what would 0.5% lower interest rate save you in that scenario? The premise here is that if a property cash flows or pays for itself, the interest rate is of far less concern. The reason being, someone else is paying down the debt on your appreciating asset. Positive cash flow offsets rate entirely. If you find a property that pays for itself, the interest rate becomes background noise. Factor number 10 is rental conversion potential. Even a home purchased as a primary residence can become a cash flowing asset later. When that conversion happens, the interest rate that you locked in becomes much less relevant, and it's also probably a pretty good deal because primary residences get lower interest rates than investment properties. So someone who bought at the same time as you and bought an investment property isn't going to have as good of a rate as you do, and now you're cash flowing or you have somebody else paying down the mortgage. Let's take a look at a live-in then rent scenario. So let's say you bought the house today at a 6.5% interest rate and it cost $400,000. Your mortgage payment was $2,500. You live there for 5 years, the home appreciates to $535,000. Now let's say you rent it out for $2,800 a month. Your monthly cash flow in that scenario would be $271 a month. Now let's say rates drop and you get the opportunity to refinance. Let's say rates drop a full point and down to 5.5%. Your payment drops down to $2,271 a month, and your cash flow jumps to $528 a month. What may have seemed to some like a high rate loan is now a very healthily cash flowing asset to you, all because you owned it. Today's interest rate, even if it may seem less desirable, can become tomorrow's cash flowing rental. If you think in time horizons and not just payments, you'll come out on top. Factor number 11 is the opportunity cost of money. So every dollar that you put towards paying down your mortgage faster, a bigger down payment, or even an interest rate buy down is a dollar that you didn't invest somewhere else. And it really all comes down to the rate of return. If you're able to get a greater return on your money than you are having it tied up in a mortgage, whether it's at 4, 5, or 6% interest, then you're better off a lot of the time taking that cash and investing it somewhere else that's going to give you a bigger return on investment. So let's take a look at this scenario. So let's say there was a buyer and they were thinking about putting an extra $50,000 down as a down payment. Let's see what that would do in the house and what it would do as an investment. So they were going to get a 6.5% interest rate. They were going to put down the extra $50,000, which was going to reduce their monthly payment and their principal to the point where they would save $316 a month. Now, let's say they took that $50,000 and they invested it for 10 years at 10%. At the end of the 10 years, they would have $129,000 and some change. Subtract their initial investment, and they would have made $79,600 in profits. So in this scenario, the smarter financial move is to take the bigger mortgage and invest the difference. Your mortgage is not always the highest return use of your capital. Sometimes keeping money invested beats paying down a lower interest loan. Factor number 12 is exit strategy flexibility. A property with multiple exit strategies is always going to beat out a marginally lower rate because you're going to be able to maintain flexibility regardless of market conditions. There are 3 exit strategies that any good property should have. The first one is sell. You should be able to sell at a profit. The second one is refinance. You should be able to refinance to a lower rate if you want to take advantage of that, or to be able to refinance and pull out cash. And the third is to be able to rent. The property should be able to rent and support itself if you decide to move on or hold the asset. Other exit strategies may be short-term rentals or Airbnb, a 1031 exchange into another property, refinancing to specifically pull out cash to acquire another property, or extending seller financing to another buyer and basically becoming the bank on your own property. So let's check out some simple exit math on a sale. So let's say you own a property, you bought it for $400,000 at a rate of 6.5%. 5 years later, you're going to sell that property, which is now worth $500,000. After the estimated selling costs of about 6%, you sell and you pay off the remaining loan balance. Your profit after those costs is $95,556. The interest that you paid on the loan was $10,000. You subtract that and you are at around $85,000 in net profits. When you make a profit at exit like $85,000, the interest really becomes background noise because you came out ahead. So every good property should have at least 3 ways to win, because a flexible asset is always going to beat a trapped asset, even if that trapped asset has a lower rate. Factor number 13 is refinance potential. The rate is not permanent. The rate you enter into a house at is usually not the rate that you keep, meaning that a higher rate today is not a life sentence. Rates cycle, market cycle. Refinancing your loan later is something that can dramatically improve your position, all while you have been able to capture appreciation before you refinance. Let's check out this example. So you had an original loan. The balance of the loan is $400,000. The interest rate is 6.5%. Your original payment was $2,528. And after 3 years, your loan balance is $385,000. Now let's say you refinance that remaining loan balance to a 5.5%. So you're going to go down a full point in interest, and your monthly savings are going to be $240 a month. Your annual savings are $2,889 a month. Now let's see what you didn't give up by waiting and by getting into the property at 6.5% and then refinancing to 5.5%. So at 6% appreciation per year, the home over those 3 years before you refinance would have appreciated $76,000. If you take a look at the interest rate savings, which would have been around $12,000, and you subtract that from the $76,000, you're going to get $64,000 in equity that you did not miss out on because you actually had control of the property and owned the property during that first 3 years, even at the higher interest rate. And even beyond appreciation and equity, having control of the property when rates have gone down is oftentimes a really beneficial thing, because when rates are improving, the market shifts to be more in the favor of sellers. People are more willing to put down cash offers, they will compete with you, and you don't often get your pick of the litter as far as the house or the property that you want, because they're flying off the market like hotcakes with people trying to take advantage of better interest rates, quote unquote. So what you really want to do is you want to lock in the house that you want at the price that you want, and then later on down the road, you can refinance and really take advantage of the best rates rather than trying to time your purchase and your rates all in one. Because most of the time, even if you do that, rates will improve at some point and you'll still end up refinancing your house. And if you think back to 2020, 2021, this is exactly what happened. People were coming in with cash offers. People with smaller down payments weren't getting their offers accepted. And so even though it seemed like it was a great time to buy, it was actually a very difficult time to buy for a lot of people. So as the saying goes, marry the house, date the rate. Rates can be changed, purchase price remains the same. Factor number 14 is unit count of the property. So we already kind of looked at the cash flow aspect of this, but now we're going to look at the unit count aspect of this, because you can scale that unit count up depending on the property type and depending on how many properties you own. So let's take a look. So when you have a multi-unit property, the math fundamentally changes. When rental income offsets the mortgage or covers it entirely, the interest rate becomes much less relevant. The real loss in a multi-unit situation is waiting, because appreciation will kill you. As markets go up, these properties tend to get more expensive and cash flow gets reduced the longer you wait. So let's take a look at a couple of examples. So in our first example, we're going to look at a duplex, and then we're going to look at a fourplex, and then we're going to look at what if we had a couple of fourplexes. So in our duplex example, we've got a purchase price of $480,000. We've got an interest rate of 6.5%. Our monthly payment on the loan amount of $456,000 is $2,882 a month. And we have 2 units, and they're both rented out for $1,500. That's $3,000 a month in rent income. You subtract the mortgage from that, $2,882 minus $3,000, and you are net positive $118 a month. So in this scenario, you own your appreciating asset, your renters are paying down the debt for you, and you are making a small net profit. Would a lower interest rate be nice? Of course. And when it's time to refinance, if it makes sense for you, that's exactly what you're going to get. It's going to bump up your cash flow a little bit, but ultimately, this property is already a good investment. Now let's take a look at a fourplex. So in this scenario, our fourplex has 4 rental units. They're each rented out for $1,500 each. The mortgage is $600,000 at 6.5%. So 4 units, $1,500 each, that's $6,000 in rental income each month. And we're going to subtract the mortgage payment, which is $3,792, which leaves us with $2,208 a month in profits. That's before property expenses and things like that, but still, that's a very healthy cash flow, and it's a fourplex. Now, let's take this even a step further, because obviously we've done well owning this fourplex. It's cash flowing great at 6.5%, but what if we had 3 of these? So let's say you buy one, then you acquire another one, and then you acquire another one over any given period of time, or all at one time, depending on your investing strategy and where you're at. Ultimately, that would give you 3 fourplexes. So you would have 12 rented units, and you would be cash flowing $6,624 a month. So if you wait for a lower rate to buy a multi-unit property that's a good deal, you're not saving anything. You're losing months of rental income, months of appreciation, months of equity builds. So ultimately, the opportunity cost of waiting will dwarf any savings from interest rate. On a multi-unit property, renters are paying your mortgage. So waiting for a lower interest rate really just means that they're paying someone else's mortgage instead. Your primary residence is far more than a shelter. It's a leveraged, appreciating, tax-advantaged asset that forces savings, builds equity, and creates wealth that renting never can. Ultimately, the interest rate on your primary home matters far less than just being in the asset. So let's take a look at what your primary residence does for you. Well, first off, appreciation. The entire value of your home grows over time, creating wealth from your investment in your home. Forced savings. This means that every payment that you make builds your wealth. Rather than giving your money away to a landlord, you are putting your money back in your own account, essentially. Leverage. You control a $400,000, $500,000, or $600,000 asset with anywhere from 0 to 5% down, 20% down if you really want to put more down. But it could be as little as 0% depending on the loan program, 0 to 3.5%. So you're able to control a very large asset with very little invested into it. And tax benefits. You can get interest deductions, capital gains exclusions, and property tax deductions, to name a few. Stability. You get fixed payments versus rising rents, and you even get the option to reduce your payment. While rent is going up everywhere, you can go and refinance when rates go down and you can get a lower payment. Future income potential. Eventually you could move out, you could rent it, you could add an ADU or a guest house, or you could use the BRRR strategy, which I can go more into in another video, but essentially you are going to renovate the house, create equity, pull out the cash from that renovation, and then you use that cash to go and buy another rental property. So now you have this property rented out and you've got another rental property, and so on and so forth. You can repeat this entire strategy to grow an entire real estate portfolio, and many investors use that exact method. And for a lot of people, that starts with their first home. Let's take a look at a leverage example. So you buy a $400,000 home, you put 5% down on it, that's $20,000. It appreciates 6% a year. The first year alone, it appreciates $24,000. So you earned more than your entire down payment in 1 year. Your effective cash on cash return is 120% in this example. Your primary home is not an expense. It's a leveraged investment with multiple advantages that forces you to build wealth every single month. Factor number 16 is tax advantages. The government subsidizes your mortgage. The U.S. tax code is specifically designed to incentivize homeownership. When you factor in the tax benefits available to homeowners and real estate investors, the after-tax cost of a mortgage is significantly lower than what you see on paper. There are many of these tax advantages. I'm going to give you 3 examples. The first example is mortgage interest deduction. Every dollar of interest you pay on a mortgage reduces your taxable income. This is one of the largest deductions that's available to most Americans. So let's take a look at year 1 on a $400,000 loan at 6.5% interest. So year 1, the approximate interest paid is $25,868. Let's say it's a 24% tax bracket. So the tax savings would be $25,868, which is the interest paid, times 24, which is the tax bracket, and you're going to get $6,208. So you divide that $6,208 in savings by 12 months for the 1 year, and you get $517 a month in interest saved. That's huge. So the government is essentially paying part of your mortgage. The second tax advantage is depreciation. So for investment in rental properties, the IRS allows you to deduct depreciation on the structure over a period of 27.5 years. And this applies even if the value of the actual property is going up. So this is a paper loss that allows you to reduce your taxable income. Let's take a look at an example. So in this example, we've got a property value of $300,000. We're excluding the land in this case. The annual depreciation is $300,000 divided by 27.5, which equals $10,909 a year. The tax bracket is 24, so we're going to look at the annual tax savings by multiplying the $10,909 by the 24%, giving us $2,618 in savings per year. We're going to divide that by 12, and that comes out to $218 per month. So you've got a non-cash deduction that effectively reduces the cost of your mortgage every month. The next tax advantage is capital gains exclusion. When you sell a primary residence, the IRS gives you a massive gift. $250,000 in profit that is completely tax-free. $500,000 if you're married, as long as you've lived there for 2 out of the last 5 years. In contrast, if you sell stocks at a profit, you're going to pay anywhere from 15 to 20% capital gains tax on every dollar of profit that you made. On a home, you're paying nothing on substantial gains. Let's take a look at some quick math on this. Let's say that you sold a primary residence, you bought it for $400,000, you sell it for $600,000. Your gain is $200,000. The capital gains tax owed is 0. Now let's say you did the same thing with a stock account. Capital gains at 15% on that same $200,000 in profit would be $30,000 owed to the IRS. In this example alone, homeownership has a $30,000 tax advantage. And this is just one of the tax advantages of many. So since the government incentivizes homeownership through tax code, after tax benefits, your real rate is significantly lower than what's seen on your mortgage note. Factor number 17, the true cost of a property. Rate is only one line item in the cost of a property. Buyers who fixate on rate will often ignore other components of their monthly payment, like homeowners insurance, HOA fees, property taxes, and maintenance. These costs can be large enough to make any difference in rate fairly insignificant. Even cheaper properties can sometimes come with high carrying costs, which makes looking at all the costs associated with your monthly payment very important. Let's take a look at an example that shows two different properties, same loan amount, same interest rate, but different carrying costs. Property A has lower taxes and insurance, and property B has higher taxes and insurance. So property A has a mortgage payment of $2,528 a month. The taxes and insurance combined are $450 a month, and the total principal, interest, taxes, and insurance are $2,978 a month. Now property B has higher insurance and taxes. The mortgage payment is $2,528 a month, same payment. The property taxes and insurance are $850 a month combined, bringing the grand total of the principal, interest, taxes, and insurance up to $3,378 a month. So that is a $400 difference between the two payments, which is about 3 times what a 0.5% rate would either save you or cost you. So as you can see, a careful cost analysis of a property is usually going to save you more monthly than a slightly different interest rate. So at the end of the day, you want to be comparing total payments, not just interest rates. Even with a low interest rate, you can still end up with a high monthly payment. Factor number 18, liquidity and emergency reserves. Putting too much cash down as a down payment just to secure a marginally lower interest rate can leave you financially exposed. Liquidity, which is the ability to access cash when needed, is often more valuable than a slightly lower interest rate. Let's check out a simple example of this. So we're going to have buyer A and buyer B. Buyer A chooses a maximum down payment. They put their full $80,000 into the down payment to get a slightly lower interest rate. Because of this, they have no cash reserves after closing. Buyer B puts down $40,000, keeping the other $40,000 in savings. They get a slightly higher interest rate. 6 months later, the HVAC goes out and the cost of the repair is $12,000. Buyer A puts this on a credit card at 24% interest. Buyer B has the savings, so they pay it cash. $12,000 after a year on a credit card. 1 year's interest on a $12,000 credit card at 24% is $2,880. So that slightly lower interest rate ended up costing that buyer all of their cash reserves and credit card interest. Liquidity is a financial asset. Don't drain your reserves just to buy down an interest rate. The emergency fund is the strategy. Factor 19 is time horizon. How long will you hold the loan? Interest rate matters over time. If you're not planning to hold the loan for a long time because you plan to sell, move, refinance, or rent out the property, the difference in interest really becomes mathematically tiny. Most Americans won't keep their mortgage for 30 years. On average, people are only in a mortgage for between 5 to 8 years, which really changes the numbers. Let's take a look at an example. Let's look at the rate difference between two mortgages holding that mortgage for 5 years. So we're going to look at a loan of $400,000, and we're going to look at an interest rate of 6% and 6.5%. The difference between the 6 and the 6.5% monthly is $130. If you look at that over a 5-year period, 130 times 60 months is $7,804. That's really not life-changing money. The appreciation, the equity, and the exit strategy are going to matter far more, as we've seen in previous examples, than $7,000 in interest. This also applies to paying points. The break even on most interest rate buydowns is going to be between 5 and 7 years. So if you don't plan to hold your loan for 5 to 7 years, you're paying for a benefit that you never receive. Focus instead on the value of the asset and your exit strategy, and you'll come out on top. Most homeowners simply never keep their mortgage long enough for rate to matter all that much. It's better to think in time horizons, not just rates. Factor number 20, the cost of waiting for a lower rate. Buyers who wait for rates to fall almost always lose more in appreciation, increased property taxes, increased carrying costs than they ever would in interest rate savings, especially taking into consideration some of the other strategies that we discussed earlier in the video. This math hits pretty hard. Let's take a look. Let's say the home price today is $400,000. We've got an interest rate of 6.5%. The monthly payment with 5% down would be $2,401. Now let's say you waited 12 months. This particular market is appreciating at about 7%. After 12 months, the home would cost $428,000. Now let's say in that 12 months, the interest rate dropped from 6.5% to 6%. Even with the rate drop, your monthly payment would be $35 higher, not lower, because of the increased purchase price of the home. And your net loss before even making a payment would be the $28,000 in appreciation that you missed out on by not owning the home a year earlier. And this doesn't even include the rent that you were paying during that 12-month waiting period. So let's say that your rent was $1,800 a month times 12, that's $21,600 gone with nothing to show for it. So if you add in that rent over just 1 year, you've now lost out on $49,600 and you ended up with a higher monthly payment. So waiting for a lower rate lost you appreciation, cost you more on the house, and you ended up with a higher monthly payment. The math of waiting simply does not work in the buyer's favor. Factor number 21 is inflation, your silent mortgage partner. Inflation is one of the most misunderstood topics in real estate, and it works entirely in the borrower's favor. Your mortgage is fixed in dollar terms, but inflation means that those dollars become worth less every year. So in reality, your payment is actually shrinking over time. Let's imagine that you locked in a mortgage payment of $2,500 today. In 10 years, if inflation averaged 3% per year, that same $2,500 payment would only have the purchasing power of $1,860 in today's dollars. If that seems confusing, let's take a look at a little bit more of an in-depth example. So let's say that you have a mortgage rate of 6.5%. Average inflation per year is 3%. That would mean that the real cost of borrowing is your 6.5% rate minus the 3% inflation rate, which would equal 3.5%. Now let's look at how your purchasing power changes over time and how your payment actually shrinks. So today, $2,500 is $2,500. In 5 years, at 3% inflation, that same $2,500 in today's dollars would only be $2,157. And in 10 years, that same $2,500 becomes $1,860 in today's dollars. And in 20 years, it becomes $1,384 in today's dollars. Meanwhile, your home, the asset, actually keeps up with inflation, meaning that a $400,000 home at 3% general inflation in 10 years would be worth $537,000, and that's before any real appreciation is factored in. Inflation is actually quietly reducing the real cost of your mortgage year after year. Time is on the borrower's side. Factor number 22 is income growth. Your mortgage gets easier every year as your income grows. When you buy a home, your mortgage payment is fixed. Your income is not. So when you first buy a home, your monthly payment may feel like a significant portion of your income, but as your income increases, that payment starts to feel smaller and smaller. So while you grow your income, you also grow the appreciation in the home rather than throwing money away on rent. And as that income grows, you can continue to invest it. Let's take a look at some math on how income growth should be factored in. Let's say your year one income is $5,000. Your mortgage payment is $2,500. Your debt to income ratio is 50%. Now let's say your year 5 income is $8,000. Your mortgage payment is still $2,500, and now your debt to income ratio is 20%. So even if over that 5-year period, interest rates went down a little bit and saved you a couple $100 a month, you still grew your income by $3,000 per month. So if you had invested even a small portion of that increased income and taken a small portion and added a little bit of an extra monthly payment to your mortgage, you would easily have outperformed any rate savings by driving down the time that it takes to pay off the loan, driving down the interest, and gaining a superior return on investment on your money. Not to mention your property's been appreciating that whole time. Your income will grow, your mortgage will not. So time and income growth will make your payment feel smaller every year. And that income growth, properly allocated, will make you significantly more than waiting to buy a property ever could. Factor number 23 is why buyers fixate on rate. It's important to understand why this happens so that you can really see the big picture. Consumers obsess over interest rate because the mortgage industry markets it aggressively. Rate is simple to compare, it's easy to advertise, and it's emotionally compelling. But sophisticated buyers focus on entirely different variables because they understand where wealth comes from in real estate. Something valuable to keep in mind when thinking about this topic is that rates really are where they are. The market is where it is. You might go from one mortgage company to the next and find that they are an eighth of a point cheaper, maybe a half a point cheaper. But in general, the rates that a lender is offering are the rates that the market dictates. And another thing that you want to keep an eye on is, what are the professionals doing? If you look across all market conditions, real estate professionals are always investing, because they understand this to be true. They know that what makes a good investment isn't the rate, it's all the other things to do with the property, irrespective of the rate. Obviously, you want to get a good rate for the market that you're in, but emotionally determining whether something is high or low is not how professionals operate. So what amateurs tend to focus on is the interest rate. Is it above or below some psychological threshold? They'll be doing constant rate comparisons, shopping across 12 different lenders for an eighth or a quarter of a point different interest rate, or comparing their loan to their friend's loan, and their friend's putting 20% down and they're putting 3% down, and they're searching high and low for that interest rate that their friend got, and it's never going to be there because they're two completely different loan scenarios. And what professionals focus on is totally different. Professionals are focusing on cash flow. How much cash flow does this property generate a month? Return on investment. What is my return on my money on this property? Appreciation potential. Is this market an asset priced to grow? Leverage efficiency. How much asset do I control per dollar invested? Tax efficiency. What is my after-tax cost and after-tax return? Exit flexibility. How many ways can I win on this property? The real question for them isn't, is the rate good? It's, is this the right asset at the right price with multiple ways to win? An interest rate will always be a fixed number. Your financial life is dynamic. You want to stop optimizing for one number and start optimizing your decision as a whole. Factor number 24 is other investments. Real estate is just one part of the system. Your mortgage is not your only investment. It's just a little part of your total financial picture. Smart buyers look at how real estate fits alongside other investments: equities, business ownership, private lending, and other assets. They optimize for the whole system, not just the mortgage. Let's look at some of the unique advantages that real estate brings to your total investment portfolio. The first is leverage. You can control a $400,000 real estate asset with $0 to $20,000 down as a primary buyer. There's no brokerage account that gives you 20 to 1 leverage on appreciating assets. Next is tax efficiency. Depreciation, deductions, and capital gains exclusions reduce after-tax costs. Inflation hedge. The asset value and rents are going to rise with inflation, while your debt stays fixed. Cash flow. Your property can generate monthly income that no stock dividend can match in accessibility. Meaning, while the bank is financing most of your property, you'd be paying for the entire stock portfolio to generate that same dividend income. And equity building. Every payment that you make increases your net worth automatically. An interest rate difference affects one line in one item of your portfolio. The decision whether to own that asset and which asset to own affects your entire trajectory. You want to think at the systems level. Your mortgage isn't your only investment. It's just one piece in a bigger financial system. Your focus should be on optimizing the system, not just the rate. And our final factor, rate versus reality. After examining 24 factors, the conclusion is clear. Rate is just one variable in a multivariable equation, and rarely the most important one. Buyers who build the most wealth in real estate are not the ones who found the lowest rate. They're the ones who found the right asset in the right market with the right strategy. What a rate can't do. A rate can't fix an overpriced purchase. A rate can't eliminate higher carrying costs. A rate can't create appreciation in a weak market. A rate can't add the rental income that additional units can. A rate can't recover years of lost appreciation while waiting. And a rate cannot replace strategic paydown, smart exits, or tax strategy. What does build wealth in real estate? Buying the right asset at the right price, markets with strong appreciation potential, using strategy to accelerate paydown and equity growth, leveraging tax advantages to reduce the cost of real ownership, maintaining liquidity to capitalize on opportunity, and acting, because waiting is never free. An interest rate is just a fixed number in a large financial equation that is your financial life. And when it comes to rates, interestingly, when you look across a broad enough time horizon, the rates that people are considering high today are actually low compared to where interest rates have been throughout history. Starting around the 1950s to today, rates have typically spent more time higher than this, and at times significantly higher than this, in the 10, 12, 15, even 17% range. So it's important to look at these things across a broad enough time horizon, not what were rates a couple years ago, but what have they been historically, and where are we in comparison to that? That really puts things into perspective and shows that on a smaller time horizon, what may be considered high on a longer time horizon is actually pretty low. I hope that you found this video helpful. Quick disclaimer, these examples are for informational purposes only. Numbers will vary based on your situation, your loan, your taxes, and many other factors. This video should not be considered tax, legal, or financial advice. Always consult with a qualified professional to review your specific scenario. If you'd like me to help you structure things the right way, whether it be a purchase, loan setup, or timing, I've got a few openings over the next couple weeks. We'll map out the full strategy so that you're not leaving tens of thousands on the table. Reach out and we'll build your plan.